Thank everybody for joining us today. We really appreciate it. My name is Brian Lockett. I'm the lead advisor here at Comprehensive Wealth Management, and as you guys have already witnessed, our Chief Investment Officer, Morgan Arford, is with us. But the stranger on the line is Joyce Huang. She's all the way out from New York City. Thank you so much for joining us. We really do appreciate it. Sorry we didn't order up the good weather for you. Hopefully it'll be nice by the time you leave.
Just in time, but
Yeah,
probably.
just in time, exactly. First up is Morgan Arford, our Chief Investment Officer. I don't think he's a stranger to anyone here, and he is actually going to take you through Comprehensive Wealth Management's perspective on markets. But before we do that, I want to point out why we call this perspectives. We want to get perspectives outside of ours. We like to say we want to triangulate. And Joyce, I know you agree with this. We told Joyce when she does her presentation after Morgan's, she is allowed to disagree. That is the point. I heard a great analogy. If I'm in a room of, let's say, 100 different portfolio managers, and I ask them, what is the best strategy right now? What do you think the answer is? 100 different perspectives, right? The consensus is there is no consensus, and this is why we do this. And with that, Morgan, take us away.
Great. Well, thank you everybody for tuning in today. My comments will be relatively short, but we're going to pack a whole bunch into it. One thing I'm always challenged by my team is I have a deck with, I think, 236 slides in it. You're not going to get that today, don't worry. But what they always challenge me to do is say, hey, what's the one slide to explain everything? And this is it. This is our factor wheel. This is where we explain over 140 variables in 5 categories. And so what we're looking at right now is primarily an actually very optimistic future bullish outcome or forecast for markets, with the exception of valuations. And we'll get into that in just a moment. Valuations really is the big concern of the moment. But what we're seeing in the economy is we actually have strong services and manufacturing data. We have strong government deficit spending, which for a lot of us is something we actually kind of get concerned about. But for the economy and stock markets, we like it when the government is just throwing money at everything, and they are right now to the tune of $13 trillion. We like corporate spending, the huge data build out for all these data centers you read about in the news. That is a big economic push into the marketplace. And we're going to see a massive amount of tax refunds this year, thanks to the OBA bill. That's the One Big Beautiful Bill Act. All that said, to put that in a nutshell, there's a lot of money flowing into the economy, and the economy so far is holding up real well. Brian, did you want to chime in?
Yeah, I wanted you, if you don't mind taking a second, because I see people get these intertwined or mixed up all the time. The difference between deficit and debt
Sure.
from the government standpoint.
Debt exists because there were deficits. Deficit is saying I am spending more money on my credit card this year, therefore I'm going to have more debt in the future. So we are primed to spend $13 trillion more this year than we actually receive in tax revenue. So we're living high on the hog as a people in our nation.
Yeah,
Okay, Brian?
that's a lot. No, that's exactly it. Thank you.
Okay. Another piece here, and this one's going to be a little harder to understand, is we're actually seeing fear from investors from the first time in a long time. And that's, of course, because of what we're seeing overseas and in the Middle East again, as we have seen an eruption of conflict, which itself is not a great thing, obviously. It's driving up oil prices. That is not a good thing, obviously. But it is making investors more cautious. You are seeing, stocks get sold off here in the last, week and a half. And what we love is cheaper valuations, which are still high, but they're cheaper. But we're seeing rising levels of panic where maybe things are being sold inappropriately. This is a positive sign overall. The best time to buy anything is when it's on sale, or as Warren Buffett is famous for saying, but no, buy when there's blood in the streets. Hopefully there won't be blood literally in the streets. I don't really want to have that conversation. But what we're seeing is people who are being overly cautious and are ignoring some of the more positive economic variables because they're concerned about what's happening on the other side of the world, which hopefully it stays there.
So really, fear is creating an opportunity for our clients right now.
In the longer term, momentum is also somewhat of a sentiment, indicator, because momentum is prices going up over time, and price in the marketplace is really all of us voting on what we think is going to happen. We think stocks are worth more, companies are worth more than they are right now, and so we're pushing prices up and up and up, and that's happening over a long period of time. So what we can look at is say, hey, in the short term, people are overly fearful. In the long term, they're optimistic. All 3 of these combined are positive indicators. I hope you're all enjoying my squiggly line charts. I'm having a great time just drawing on this thing today.
You're killing it. They look great.
Art was not my forte. Interest rates, this is a bit of a neutral one. And we have this marked neutral, one, because you still have interest rates sharply higher from a few years ago. You still have inflation sharply higher from a few years ago. Affordability is going to be the big campaign word this year in the midterm elections. and we have now sharply higher oil prices. We were expecting to have multiple rate cuts, quarter point rate cuts from the Federal Reserve this year, thereby making borrowing costs cheaper. We now no longer know if we're going to get that because oil being higher is inflationary. You may see the Federal Reserve back off of those plans. What that means is rates are still lower than they were a year ago, but we may not get any more rate cuts. And no, this is our neutral territory. Valuations, these are still
So Morgan,
nosebleed
before you
levels.
go on to valuation, I want to
Sure.
ask you on interest. So when you said affordability is going to be a big topic of the midterms, I assume you're talking about housing,
I'm talking about anything. So
anything, everything being
if you look at
affordable.
the last 5 years, prices have gone straight up and now they're going up slower. We're still seeing inflationary pressures. It's not as fast of inflationary pressures, but we sure as heck are not seeing prices come down. So affordability, lots of which is driven by all kinds of different variables, has not become better in the recent time frame, the last year and a
Sure,
half. So
sure.
this is going to be a big piece, and you're going to hear that word over and over and over again. So, and affordability is also the reason why we're concerned about stocks because they're not very cheap, at least not domestically. Right? To kind of emphasize that point, let's talk about our favorite measure of valuation, market capitalization to gross domestic product. Think of that as the total price of all stocks combined divided by the economic output of the country. And what we can see is here is the average or the mean in statistics term. Here is where current valuations are, which is almost three standard deviations above the average. For those of you who don't speak stats, there's a nice definition right down here at the bottom for what standard deviation is. Basically, what this chart is saying is things are really, really expensive to the point we've never seen before on the data set's history. When we look at this environment, what we're looking at is, hey, what happens if we get a mean reversion event? Well, that would be a 47% decline from there. To get back to a standard level of normal, one standard deviation, that itself is a 31% decline. So this is the big fear right now is we have great news in other areas, but valuation itself is suggesting that there are extreme risks. So if we're going to be bullish about markets, what should we do? We should go look at places that are cheaper. Brian also wants me to point out that there are lots of different measures of valuation, and the vast majority of them, at least for our domestic markets, are expensive.
Yeah.
But if we look abroad using a thing called a CAPE ratio, which is another form of valuation metric, what we can see is if we look at the rest of the world, they're not nearly as expensive as the US is. And they have higher levels of income being paid. So you can buy the US with high valuations and low income, or you can buy other parts of the world at lower valuations and higher income. We can be invested. We just need to be more selective about what we invest in because of the high valuation mark. So those are you guys who are in the active portfolios. You're going to have a lot more international exposure right now than you do U.S. exposure, or at least we have historically.
And isn't it true, Morgan, that another reason, not only are they cheap and paying more in dividends, which is obviously a very attractive offer there, but with the dollar going down, investing in other countries where you're priced in their currency versus the dollar is also beneficial.
Correct. Yeah. If the dollar falling is a tailwind for international assets, a tailwind for things like precious metals, which are also another big holding in active portfolios, in all portfolios, really. So let's move on to the bull case. Why are we optimistic? Well, we have $13 trillion in deficits to be optimistic. Now, normally when you have this level of deficit spending, you have recessions. You have all these gray lines. Those were recessions historically. And what typically happens when you have recessions is the powers that be in a democracy in particular say, we want to make economics better. So let's dip into the piggy bank or into the credit card and boost spending. Here was the 2020 COVID crisis. You can see what happened in that environment. Also, was what fed into the inflationary pressures that followed it. But right now, this being so high is a reason for positivity. Part of what's driving that are policies like the OBA bill, the One Big Beautiful Bill Act, which is extending tax cuts. It's enabling more recognition of capex spending and the ability to write it off. But for most individual people, it means a big boost in returns or refunds, I should say. You're going to see a 43% jump for the average American over 2025. What do the average Americans do when they get a big refund? They spend it. This is money, this is again money that's going to flow into the economy, that's going to get spent, and hopefully not at the gas station. We'll see what happens there with that.
Yeah, I wanted to point out here. I was looking at there are 161 million tax returns filed per year on average.
Hmm.
Just using the average, let's call it $1,000 per return more. That's $161 billion in refunds. But I also want to point out for everyone on the call today, from what I saw, you live around here. And the change in the SALT cap going from 10,000 to 40,000 is going to be incredibly beneficial for around here because we're a high property tax state. And so that should see a real boon to our clients.
Yep. One last piece on this page is, we're looking at a GDP boost overall from this. So you have more money flowing into the economy, higher GDP, higher growth. That's good for jobs, economics, etc. On top of that, we have the spending from the hyperscaler tech companies. Hyperscalers being the companies who are spending massively to build out these gigantic data centers, one of which, called Hyperion, being built by Meta or Facebook, as most of you know it, is going to be roughly half the size of Manhattan. These things are gigantic. This year alone, though, we're estimating we're going to see $646 billion of CapEx spending. And to put that into some kind of context for you guys, that's equivalent to 2% of US GDP. That's roughly equivalent to the size of GDP, the combined size of GDP for Singapore, Sweden, and Argentina. That's bigger than the combined military spending of Germany, France, UK, Japan, Italy, and Canada. Roughly the same size as the market cap of Belgium, Denmark, and Indonesia, and it's the same amount of money as all U.S. bank loan in 2025 growth. And so it's pretty insane to see the amount of money flowing in, not just from the government, but also the private sector right now. And when you have money flowing into the economy at such a high clip, it's really hard to have recessions. This is an environment where, despite high valuations, you still want to own stocks because of the money flow.
Morgan, do you think because of the accelerated depreciation and so forth that you're seeing in the OBA for tax purposes, that that's in part some of the reason why they're spending so heavily on this right now?
Oh, I'm sure it's feeding. It's an incentive for sure.
I would think so too.
Yeah, absolutely.
I haven't
And
seen anyone talk about it, but it just seems logical.
again, all these things are going to be boosts to the economy. This is why you can't ignore it, and you have to be worried about inflation to some degree as well. Which brings us to our next point is, okay, what about rate cuts? Now, when we first put this chart in here, we were still expecting two rate cuts. That's a lot more of a question. What we know for now is the Fed is currently on hold. They stopped cutting rates at the beginning of this year, and now we're wondering what's going to happen in the future. If we do continue on the same path and you do see us resume the idea of getting rate cuts, that's a very positive environment for pretty much everything historically, having a pause and then more rate cuts afterwards. So again, this is just one more reason to buy into markets right now, one more reason to be more aggressive, which is why almost all of our clients have seen some type of move up the risk spectrum here in the last few months.
So there's a question. I don't know if now's the time to answer it, if you're going to answer it later, but it says, how is it that our gasoline prices spiked up so sharply as of the beginning of this Iran war when all of the gas we have been sitting on here and oil was purchased and refined at lower prices?
Yeah, absolutely great question. It's because the market is forward looking, and so they're anticipating future price hikes. And guess who gets to pay for it right away, guys? You and me.
Yeah.
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 Lastly, I want to highlight this piece. I use this chart all the time. Clients who have been around for a while have seen it. And what we know is every single year, on average, the market declines, market being the S&P 500, declines around 14% on average. Obviously, there's a range around that average. Okay. What we've already seen so far, and this is as of Monday, is a decline of only 3%. Markets have been really scary volatile the last week and a half. They haven't really gone anywhere. What I want to point out, though, is that 3%, if it's pretty low based on history. If you look back through this entire data set going back to 1980, 3% is about as low as it gets. What that probably tells us is that we should be expecting to see a volatility event in the future. And because of the high valuation situation making things maybe a little more fragile, we'd probably end up with a greater than average decline if and when it occurs. Now, I say that, and if we aren't going to get a sell-off based on the Strait of Hormuz, the waterway near Iran being shut down and oil, basically doubling in a short time frame, if that doesn't cause that sell-off, it's hard to see what could. Not saying that nothing could, but that is a demonstration of all that liquidity I was highlighting, the deficit spending, the corporate spending, the upcoming refunds. Those are all forces that are overpowering even significant geopolitical risk.
So Morgan, before you move on, I just wanted to, kind of get on my high horse here for just a little bit. I was a little annoyed at a news story the other day because the headline was the Dow plunges 1,000 points. And I'm actually in the car with my son Benjamin, who's, he gets economic lessons on the way, as you might imagine. He's 11. So does that sound like a lot, Benjamin? And he's like, yeah, sounds like a lot. So what if I told you it was 2%? Well, that doesn't sound like a lot. I said, which one do you think the media is going to report?
Yeah, which one gets clicks?
Which one gets clicks? So we say this because you're going to see very sensationalized headlines because they're selling advertising, they're selling clicks. The reality is, and this chart says it all. I mean, I'm looking at right now, real time, the stock market is down 1.09% year to date. But if you had never looked at that and you had just read the headlines, you would think it was in the toilet, we're down 25%.
Yeah.
And it's just watch out for that.
So headlines say things like we're the closest to World War III we've ever been, and the stock market year to date at worst was down 3 or 2.
So,
Its drawdown was 3%. I mean that. Okay, apparently markets don't care about this that much at this point,
yeah.
at least.
Yeah.
Not saying we shouldn't worry about it. And the way we'll handle that, if people are wondering how we're going to address the oil situation or the situation from the geopolitical issue, is that we're going to wait to see it actually affect data because most of the time it doesn't.
Well, and more before you go into this, you and I, when we were talking about this stuff before, we were always asking the question, does that current scenario, whatever it is, truly change the economics?
Correct.
And for instance, we were talking about, well, oil prices going higher. Of course, there's a tipping point, but oil prices at $85 a barrel doesn't really change things. Now, if oil prices go up and the price of everything else goes up and the Fed has to raise interest rates, that changes things. But oil alone moving to $85 a barrel is just annoying at this point. Now, the war comes onto our soil, that matters.
Right? Where's information versus where is there just market and data noise? One of the things I love to highlight about the oil situation right now is the difference between now versus the 1970s as the U.S. now is a net exporter versus a net importer. And so we're not going to have a situation of gas lines and shortages and things. We are going to be affected by a global energy economy, but it's not going to be like some of those memories of the 1970s and the hyperinflation that existed there. Yeah, which brings me to this chart I always love to highlight. We're always going to focus on the things that we can control. We can't control decision making at the government level, especially in foreign countries where we don't have a vote. But we can't control the risk exposure of a portfolio. The savings rate is really on clients to decide how much they want or able to save. Time and behavior, that's things they work on with the advisor team. What's your time horizon? How much risk can you actually take? What's that volatility window that you can take? Markets are going to do what markets are going to do, and we're going to make the best choices possible based on data in a disciplined fashion for you. I want to remind everybody there's lots of different ways to stay invested, based on how we run money. We have the more passive options where we build allocations that are shown to be successful over the long run with varying levels of risk. We also have different types of active strategies. Active being we're using data to make choices and change allocation exposures for you over time based on information that we're receiving, and that's changing. There are lots of ways to be more or less biased to risk or safety. That is a conversation to have with your advisor team if that's one you have. You feel like you're being too conservative or you feel like you're being too aggressive in the current moment.
So Morgan, before you depart, I want to ask you one question. Wrapping a bow around everything you just said, what would you say is kind of the theme right now?
The theme right now, and Brian, you've heard me say this, which I'm sure you're leading the question here, is like right now we believe in being aggressive and buying stocks, but we also believe the value story says buy anything but the S&P 500.
Yeah. And that's because it's really hard to have a recession because of all the money sloshing around the system between the OBA, all the AI infrastructure build out. I don't even think you mentioned the stimulus overseas, like in Germany and Japan that we're seeing.
I did. Oh, yeah. Right? Other places too. Yep.
It's just really hard to have a recession. And that's one of the things, if I recall, that you had really concluded in all of your research is that despite bad circumstances, when you have massive deficit spending and everything like this, it kind of papers over the problem, which warrants being more in risk, i.e. stock and stock-like assets versus being in bonds, which Joyce, I know you're a bond manager. Sorry to say that about bonds. Bonds have their place, but is that correct? Am I summarizing that right?
Yeah, absolutely. Absolutely. And we are over time, so I got to get Joyce in here. Joyce, thank you for waiting patiently. Joyce from American Century, everybody. Take it away.
Thank Morgan. You. Yeah, I will. Morgan and Brian hinted at it, but I am a fixed income specialist. I started my career actually during the last recession, so the global financial crisis of 2008. I was one of those people that was pictured walking out of Lehman Brothers holding my box. So,
Oh, brutal.
yeah, you learn on the job, right? Free
That's brutal.
education.
Rough.
So a lot of, I was hoping that I would have something to disagree with Morgan about to keep it a little bit interesting, but a lot of what we have been thinking about at American Century is really aligned with what he mentioned. So I always like to look back at 2025 just to put in context everything that's happened and to put the year-to-date moves in context, right? Last year was a phenomenal year where things that haven't worked for a long time finally paid dividends. So diversification finally paid off. Emerging market stocks were the best performer, followed
Finally.
by the EFA, which is the developed foreign index. So I've been in the industry for over 20 years. I would say the most frequently asked question is like, when are international stocks finally going to outperform? Last year was the year, right?
Finally.
Finally. My colleagues on our global equity teams were thrilled last year because they finally got to be like, see, it finally happened.
Now,
Um,
Joyce, I wanted to ask you a question here because
mhm.
I saw this and I haven't peeled back the onion. In the emerging market space, what were the performers? Because when we saw the emerging markets boom in the mid aughts, let's call it, it was all China, China, China. What was it last year? Who was really driving that emerging markets performance?
Yeah, so China is still a very large part of the emerging market equity index. So one thing that you do have is a very high correlation to China, but because of the weaker dollar and because of the demand for commodities, a lot of other emerging markets were also able to do well. So that was really a very well-rounded year for EM.
Interesting.
But that's not to say that, everyone was thinking about Mag 7 crashing. That was still a very strong returner, right? So everything kind of worked last year, some more than others. Again, fixed income, I get excited when I get into mid to high single digits. In my mind, it's like bonds. It's like it's like a bonus, right? It's like
Yeah.
free money. You're like, great. So
That's funny.
bonds were up mid to high single digits, depending on how much credit risk you took. So everything generally worked. So that's just to kind of put into context. Last year was a phenomenal year in the markets. This year we're getting a little bit of volatility, but thinking about things that we think are going to be driving the short to intermediate term view for this year, putting aside the Iran war for a second. But I think if you think back, the news cycle is so quick. I think 2 weeks ago, before the Iran war started, it was the AI crisis, right? So everyone's like, is AI going to disrupt software? That was the first thing to sell off. Is AI going to disrupt wealth management? That was the next thing to sell off. Is AI going to, like, when they had the AI movie actress out, it's like, is AI going to disrupt entertainment? All those stocks sold off. So it's kind of this like rolling questioning of the impact of AI.
Hmm.
But this is, again, just to Morgan's point about the amount of CapEx spending that these Mag 7 companies are doing in the AI build out. You can see here again, it's already over 1.5% projected of US GDP from just four different companies: Microsoft, Amazon, Alphabet, and Meta. And that's not even including all of the others, such as like Oracle and things like that. But you can see that that is one reason why we do think, again, a recession is not likely. That is a very small tail risk scenario. We'll talk a little bit more about what we could see happening in that situation, but we do project GDP growth to be positive and maybe at or slightly below trend this year, which is right around that 2% level.
Well, I have to ask you a question here, and I'm sorry. Just I've been dying to know the answer to this. So I was reading an article yesterday, and it was Oracle, OpenAI, and one other company. I don't remember the one. You probably saw it. And they were basically saying they had to back away from this build-out deal because they realized in order to have a 2 gigawatt data center, that they actually had to have their own private nuclear reactor, and that they didn't have the
Yes.
means. to build
So
that.
that's
And I was just
actually
blown away by that.
that's actually the problem here is that we are limited in the data center build out by energy. So that's why I was talking to some of my colleagues in the office last week, and it was like, why am I suddenly getting all this interest in infrastructure? Like, there's all these managers coming to the market with new infrastructure funds. Like, it's like 10 years ago, that was a big theme. But everyone's like, oh, yeah, it's because of the AI developments and the energy requirements needed to sustain these really big data centers. So,
Yeah.
yes, that is one way that we think you can invest in sectors that are AI adjacent. If you're concerned about valuations in Mag 7 and, the hyperscaler stocks, why not invest in things like energy or infrastructure or, investing in the data centers, things like that that are going to benefit from this investment that we see on the right-hand side here.
This is one of the reasons we have industrials in our portfolios.
Mhm.
AI adjacent.
Exactly.
That's a great description.
Yep, AI isn't.
Thank you.
So again, we looked at this from a different perspective in some of Morgan's charts, but we are seeing elevated price to earnings ratios. But again, when you look back to the last really big bubble, which was the dot-com boom, it's not as high as it was then. And the companies that are driving the elevated price to earnings ratios today actually have earnings. So it's not like the speculative dot-com bubble where it was the promise of the internet. I'm seeing a lot of parallels drawn to, how the dot coms were too early and there was too much faith put in the internet. We know that that has come to pass. It just wasn't in 1999, 2000, right? It took a little bit longer for that to happen. So, of course, is AI going to take over our lives in the next 1 to 2 years? Most likely not. But if we're sitting here 10 years from now, I will guarantee that there will be a significant change in our everyday lives driven by the integration of AI, right?
True.
Now, this is a tricky chart for me to keep updated because things keep changing. When we updated this at the end of the year, it was before the Supreme Court decision that ruled that the tariffs were not allowed, that President Trump had rolled out during Liberation Day and since then. But, you know, he again has passed this average 15% tariff. He has, I think, another 2 months left on that. So we'll see where the end tariff rate ends up. But we know that raising money to fund the deficit gap through tariffs is the plan. So we are very certain that there will be tariffs in place for the rest of this term, right? However, even though the tariff rate has increased dramatically, you really haven't seen the trickle through effect into the inflation number. Now, a couple reasons for that. When you companies last year, if you think to like sentiment at the end of last year, companies, consumers, everyone was a little bit cautious on spending just because we weren't sure what the tariff situation was going to be. We didn't know what was going to happen. Companies didn't fully pass through a lot of the higher prices that they were facing to consumers because we had just gotten off, 3 years of super high inflation. So we were like, okay, wait, just calm down. Let's see what happens. But when I was talking to my equity colleagues who were reviewing the fourth quarter earnings calls that are just wrapped up, they were saying that a number of companies during this cycle have said that they are going to pass through more costs in the next few months. So we do anticipate that goods inflation is going to go back up. And as we know, consumer spending has remained resilient despite geopolitical uncertainty, despite higher interest rates, things like that. So companies are feeling more confident, which is bad news for us. I think that, I've gotten a number of emails from companies that I've bought from in the past who are like, buy now and stock up because we're going to be doing a price hike in the next couple of weeks.
Hmm.
So I'm definitely seeing it in my own personal experience.
Yeah, what we've basically heard is companies were eating it for a while because they didn't want to sacrifice market share in hopes that it might come down. But
Exactly.
once it becomes permanent, it's going to be, we're safe in numbers. It's everyone's going to have to raise their price. Where do you guys think rates are going to settle in at?
So in terms of inflation, that's actually where I think American Century is a little bit different than the market consensus in that we actually believe inflation is possibly a bigger risk than the rest of the market is thinking. And
Morgan's been in that camp.
it's not because we think inflation's going back to like 8 or 9%. Like, luckily, no. But I think people have written it off. Like today, we just got CPI again. People were like, oh, no problem. It's 2.4. Like, no issues. But again, that was pre-Iran war. That is pre these companies hiking prices through to consumers. That's, not incorporating the lingering effects of the energy increases like we talked about earlier. So I think it's too soon to say that inflation is off the table and it's not a problem because as we see, oh, sorry, I am, oops, hit my button. As we see, like inflation really hasn't moved yet, and we expect it to actually go up rather than down. A lot of the easing in inflation has already happened. The next leg down to get back to the 2% that the Federal Reserve wants to see is going to be a lot harder.
Mm.
Gotcha. Yeah. Sorry, I don't want to spend too much time on this slide, but where do you think tariffs are going to settle in at? 10%, 15%?
I think they're going to try to stay closer to the 15. Like we
Okay.
said, the
Okay.
deficit spending's at 13 billion. They've got to try to plug the hole, right? And if this
Right.
Iran war continues to extend much longer, I think today people, President Trump is saying it's wrapping up, you know, hopefully.
We'll
But if
see.
it keeps going, it's going to get costly, right? So
Okay.
the deficit
Good.
could increase further from there, depending on how long this goes for.
Yeah, good
Mm.
point.
Yep.
Now, this is a really interesting chart because it kind of makes the case for why I get excited about having fixed income be a real allocation in individuals' portfolios. So you can see here, the dark blue line is the most important part, and that's the yield you're getting or the income. So, bonds have a coupon payment. You get paid to hold bonds. That's your interest payment for lending these companies money. And so right now you're getting 5% in investment grade corporate credit. So these are all very solid household names that are not really at risk of bankruptcy or default. Those would be high yield corporates or junk bonds. Investment grade bonds generally do not default. So the issue is because the Federal Reserve kept interest rates for so low for so long, you can see there was a big stretch of time, pretty much all of the 2010s, where you were getting, around 3% for fixed income. So, I've talked to some advisors who have been in the business, 15 years, reasonably experienced, not as much as you, Brian. But,
I'm old.
like reasonably experienced. They're like, I don't do fixed income for my clients because there's no point. And I was like, well, that's because you learn the business when there was no point in having bonds, right? Now, like you have to go back to pre-2008 to get the same attractive yields that you're getting today in high quality bonds. And you're getting that diversification of benefit as well. So
Yeah.
I definitely am excited about the dynamics that are going on in fixed income right now for clients.
Now, not to throw a wrench in your whole fixed income thing you're talking about here, but one of the things I've been really paying attention to because of the impact it had on the bond market when it occurred is the yen carry trade and all of a sudden it having to be unwound and the impact it had. And I was just looking this morning, the yen sitting at about a buck 50 from being at 160 exchange rate to the dollar, which my understanding is that's kind of a threshold that the Japanese are going to try to hold. Is that right?
Right, right. And so that is where as a fixed income person, I get excited because you have to pay attention to all of the global dynamics that are happening. So, the Fed is in that pause right now, but the next move is probably a cut rather than a hike unless the inflation situation gets out of control. The European Central Bank, again, growth in Europe is under pressure. The United Kingdom also under pressure. All of these central banks could cut. Japan is actually the only developed market where we're seeing interest rate hikes
Yeah.
because they just got totally off cycle, right? They
Yeah.
were still in negative interest rates like 5 years ago.
They
So
finally got their wish and they don't want it.
yeah, they're fine. Like, I mean, they're actually doing like fiscal stimulus through tax cuts, increasing the deficit, all of these things that like Japan just was like, we're not doing that. They're doing it. So
Yeah.
that's a totally different situation, but it does speak to the carry effects that people have been taking advantage of. They've been borrowing cheap yen and then deploying it to buy over leveraged US assets.
Yeah. So before we move on, there's a question that came up, and this is regarding the tariffs. You want to go back to the previous screen.
Mhm.
With regards to tariffs, what do you think is going to happen with the court orders if these tariffs are illegally collected and have to be refunded?
Yeah, so that's
What
kind of what
happens? Where do they go?
that's what we're trying to figure out. I don't think anyone knows because we've never been in this position before, like what the process is going to be. But there have been lawsuits already filed about getting refunds back. I mean, I do recall that I purchased something and there was actually a line item for tariff, so I think I should put my name in the hat to get my like $20
Interesting.
back. But
Interesting.
yes,
Yeah.
this is like it's the unwind of this is going to be extremely chaotic and unclear. So I
Yeah.
wouldn't count on receiving a refund anytime soon, I think.
Yeah.
I wouldn't count on receiving a refund as a consumer, but we're talking about $150 billion that was charged to companies, and that could go onto that pile of liquidity that we were all highlighting earlier. Is now you haven't yet a quasi stimulus plan
Oh, interesting. Good
because all
point.
that gets returned. We don't know if it's actually going to be returned. That's going to be a big question. And my guess is because of the complexity, the court's going to rule in favor of the government, and also because Trump has largely reinstated, a lot of the tariff levels
Got it.
Right,
with
exactly.
with
So
other
if we
with other
take,
powers.
yeah, if we take
So
the 15, that's actually higher than what the
Correct.
effective rate was. So maybe the government just gets like a free loan on the tariff revenues. But yes, that
gotcha.
that is a big question about what happens with these refunds that companies are
Yeah.
suing for.
Right.
Yeah, that's interesting. Uncharted waters. Thank you.
Yeah. So here's where we are seeing very interesting opportunities. So you're actually starting to see a slight reversal of earnings growth. So again, we said everything was quite positive. Earnings are still positive for Mag 7, but they are slowing, right? So if you think about, every time like Nvidia reports, they have like blowout numbers and their stock is down because it's not good enough, right? Because they were growing at such a huge rate that anything other than that, people are disappointed by. But naturally, we are actually starting to see, and this is actually a positive in our eyes, is that you are seeing broadening in earnings growth where the S&P 493 is actually growing at a faster rate in 2005 than 2004. Mid caps and small caps were actually negative earnings growth and they turned positive last year. So you are starting to see a little bit of that broadening out theme, which is good for diversified portfolios.
Mhm. I
Um,
would say that follows along with our buy anything but the S&P 500 thing.
exactly.
Right.
So this is like again against the buy anything but the S&P 500. You can see that, S&P 5 large cap growth is the most overvalued sector right now. You can actually find sectors that are actually below the average of the last 20 years, right? So small caps are actually still trading at a discount, small cap growth and value, and large cap value is also trading at a discount. So again, S&P 500 did well, but there are other opportunities for diversification. We touched on international, emerging markets, even subsectors within the US. We're seeing some value there as well.
So before you move on there, are you seeing any particular sectors right now or market caps where the OBA, the tax cuts, for example, within OBA are going to be more beneficial versus another? I mean, obviously, in all the tech build out, being able to expense all of those things in the first year is beneficial. But what are some other sectors, like maybe healthcare or something like that, that would benefit if you have any opinion?
Yeah, that is one area, healthcare. I know our small cap value, a lot of the sector there that's been trading down because financials are a big piece of the small cap value index. And with interest rates starting low and then going up, that hurt a little bit. But as that stabilizes, they think financials is actually going to be a place that can be stable and less correlated to the AI fears and things like that.
So that small cap value index is full of a bunch of small and regional banks
Yeah, exactly.
that got
Regional
beat up in
banks
22. Yeah,
and
that's
healthcare.
interesting. Yeah,
Yep.
thank you.
So here's another view on that EFA index that we talked about, the developed non-US equity index. And what this is just showing is the relative gap in valuation. So really right now there is still like an all-time wide gap in the S&P being valued higher than the EFA price earnings ratio. So again, usually you see that gap out and then come back in, but so this could be an opportunity to diversify away from S&P and into developed international to look for something that has more attractive price earnings ratios because generally the gap does tend to close. So this is really a summary of the three major themes that we've been talking about with our clients. And the first is opportunities in investing in the AI beneficiaries, right? So these would be the tech leaders that you would anticipate, but again, touching on the infrastructure theme that we mentioned earlier, that is definitely a top number two. And then again, mid and small caps. So they're not necessarily building out the AI, but can the AI, as they integrate it and adopt it into their businesses, could that lead to better margins and
Yeah.
growth for mid and small cap companies? For sure. And then the diversification theme. I can't stress the importance of this one enough. It's such an opportunity right now to reset. Obviously, like the people on this call have comprehensive working with them and balancing their portfolios. But imagine if you had just, your own static portfolio and just because the S&P 500 has done so well, your portfolio is completely out of whack, right? You're way overweight. One theme. So diversification, bringing back different parts that could help whether your portfolio returns over the long run is important. So again, European industrials and defense. We know Germany is spending, like we mentioned earlier. The Japanese investments, tech, digital transformation, emerging markets, and then small caps, like we just talked about. And then the income. Take advantage of the free coupons that you're getting in bonds. You're getting diversification, income, you're getting some yield, but it's important to be active because, again, you don't think about there being a lot of AI risk in corporate bonds, but if you've seen the headlines, like Alphabet launched a century bond to help fund some of their
I did not
investments in the
see
AI.
that. So 100-year maturity?
Yes.
Oh my gosh, that's
Yeah, it was
crazy.
in the European market. So it
Wow.
kind of was like hidden, but yes, they are taking advantage of the appetite for um, yield. And so they're issuing century bonds. So
Wow.
if
That's neat.
the issuance continues and the appetite to borrow money to build data centers and infrastructure continues, you will start to see tech names becoming some of the top borrowers in the corporate index. So I would say active over passive on the fixed income side there.
Okay, interesting point. I want before you move on because we do have a question. We're in one of the most expensive real estate markets in the nation. I mean, you're coming from New York City, so I'm preaching to the choir. But, around here, a lot of people bought in the last few years. We saw those massive rate hikes in 22, and they're like, oh, their rates are going to come back down. We're going to see them come back down. But then we saw China exit buying treasury bonds. We saw Japan exit because of the yen carry trade I talked about earlier. And, we have some inflationary pressures, so the Federal Reserve can't really intervene and drive rates down. So long-term rates, which, would be basically the 10-year treasury bond rate, has been hanging around that 4% to about 4.2, maybe 4.25%, which, by the way, everyone listening, that's the mortgage rate benchmark. Yep. Where do you guys see the 10-year? Because for me, I don't see that changing. I mean, I think 6 to 6, maybe even 6.5 to 7% on a 30-year fixed mortgage is the new normal.
Don't forget massive treasury issuance.
Yes, and massive treasury. Thank you. Yes, massive supply, less demand. We know it has to happen.
Yields go up, exactly. Right. So again, it all goes back to the deficit, right? To fund the deficit, you have to keep issuing treasuries. Now, this is a little technical, but Scott Bessent does prefer to issue on the shorter end right now just to prevent the pressure on long rates, just because there hasn't been as much appetite for 20, 30-year treasury bonds. So it's been contained so far. But again, if you are issuing 1 to 2 year notes, you're going to have to keep rebuying them and keep refunding them, right? So it is quite an operation they've got going on at the Treasury. But our view is that you're right. The 10-year is likely stuck between this 4 to 4.5 range, unless something really dramatic happens. To make rates go below 4, you would have to get the recession scenario, which
that's what we've been saying. So thank you. We have to have the disinflationary pressures that allows the Federal Reserve to print money and buy our own debt. As stupid as that sounds, that's essentially the only thing that would drive that, right?
Right. Now, for mortgage rates specifically, there is something that we are watching on the agency mortgage-backed security sector, and it is that President Trump wants Fannie Mae and Freddie Mac to purchase $200 billion worth of mortgages to actually lower the mortgage spread and the rates.
Yeah, I did see some people refinancing lately, and I was curious about that because I didn't see the 10-year move.
Yes, so rates did drop a little bit. The 10-year went just below 4 earlier this year, and I think they were saying that was the lowest mortgage rate in 2 to 3 years. Yeah. And I think there was a little bit of refinancing then, but I do think though that it's clear that housing affordability, to Morgan's point, affordability is a key theme for this year. It's a midterm year. President Trump is going to want to make people think favorably about their economic situation. I wouldn't be surprised if the $200 billion gets escalated higher, and he really wants that mortgage rate to come down because that is, people spend, almost half of their income on housing. So that is a big chunk out of people's budgets.
Yeah, absolutely. Well, thank you very much. Really appreciate it. Unless you had something else, I apologize.
No, that's good.
Okay, great. Well, thank you again, Joyce, for making the time and for all the contributions. Before we go to the formal Q&A at the end, I want to talk about a new offering we have here at Comprehensive Wealth Management. I would love to say this is something that we created ourselves, but we didn't. That's the top right box there, direct indexing. This is a new offering that we have as of what would you say, Morgan, 3 months ago, 4 months ago? Something like that?
Yeah, November.
Yeah. But this technology's been around a long time. It's just that technology has not brought it to the masses until, in the last few years. And so the main goal of this strategy is to try and boost your after-tax returns through proactive tax loss harvesting. So in other words, I'm talking about making money and realizing losses all at the same time, and I can use those losses against future gains. I'm going to take you through how that works. But a really important concept to understand here is this only applies to non-qualified or non-retirement money. All right, so before we get into the mechanics, who is this best suited for? So the number one use case is investors that have large unrealized capital gains that they want to realize in the future. Well, we're sitting in here in Tech's backyard. We have a ton of clients that have massive amounts of highly appreciated company stock. Basically their entire net worth is in their home, their 401k, and their company stock, right? They would love to realize those gains, i.e. take profits, but they're going to get killed on taxes. Well, this is a strategy that could help you start to accumulate some capital losses that you can use against those future gains. Simple example. Let's say I have done this strategy, which I'll take you through the mechanics of, and I have $100,000 in capital losses that I have accumulated over here in my capital loss carry forward. I could then realize $100,000 in capital gains in my company stock over here, apply those against each other and pay zero tax. Now that's a utopian perfect example, but that's the mechanics, that's the idea for the number one use case behind this strategy. Another one is just investors, hey, I want to track the market. I would love to get market-like returns and pay less tax. That sounds fantastic. But realize that that's passive risk management. There ain't no free lunch. You're not going to get the proactivity that we have in those orange models that Morgan was pointing out earlier. And you do need to have a longer time horizon. All right, so that I can paint you a picture of how this works mechanically, we're going to talk about the S&P 500 index. And this you're looking at 30 years, 1992 to 2022, which it's hard to believe that's a 30-year period. What you'll see here, and help me out with the colors again, Morgan, because I didn't advance my chart. The upper lines are teal and the bottom lines are gray. Is that right?
Good job. Brian's colorblind for those who don't know.
They're the exact opposite for me. They look, I would say the upper ones are gray. Anyway, it's welcome to my world. Anyway, you'll notice that about 40% of the stocks in any given year in the S&P 500, so 200 out of the 500, are actually down for the year, but the index likely finished positive for the year. So that's kind of interesting. So if I were to buy the S&P 500 index, wouldn't it be really nice if I could sell the 200 losers and bank those losses and continue to ride the winners and then sell it and then apply those losses against it and pay no tax but have made money at the same time? That sounds pretty cool. So how do we do that? That's where direct indexing comes in. And I made a slight comment about it earlier. Technology really made this possible because you'll see there's really no way that you could just do pencil and paper and keep up with this. It's way too involved because it literally runs the process I'm going to tell you daily. So what you're looking at now is the S&P 500 in its raw form. So we're going to go buy all 500 companies instead of just buying the fund. And the benefit of this is I can sell off the losers as I'm going, those 200 stocks I mentioned earlier, bank those losses, but continue to track the index. Well, wait a minute. I now have the S&P 5 or the S&P 300. That's not going to perform anything like the S&P 500. So what happens in addition with this software is it's going to pair up what I sold. It's going to go buy something similar. And so this is just a snapshot in time. I think it's from Wednesday of last week, so a week ago. In this instance, the system say, you know what, I'm going to sell Microsoft, bank that loss because it hasn't had a good year, and I'm going to take that money from it, and I'm going to go buy Google because it's going to behave very similar. So we're going to maintain what we call a close tracking error. We're going to stay within about 2 to 2.5% of the S&P 500. That's what we should expect to see. And so I'm going to get similar performance. Now, I don't want to get too technical, but understand how this works. After 30 days, I can then go and buy Microsoft back in this example and maintain that capital loss. But if I buy it back 30 days or less, I've done what's called a wash sale. I don't get to keep that loss. That loss is disregarded. So obviously we want to do that. Software's keeping track of that as well. So we're always trying to keep within that tracking error. So there's an incredible amount of trading volume, as you might imagine, in this particular strategy. Thank God we have the technology to track that too, and you can import it right into your tax return. So this is not a great example, but it is a good visual representation of the benefit of this, something we call tax alpha. So this is just an example from Vanguard where had you held the S&P 500 from February 2nd, 21, all the way through the end of 2022, so about 2 years, okay? If you held the fund versus ran this index and you were harvesting losses along the way, you have about a tax alpha of 3%. So what does that mean? That's my return after I consider the tax savings over my benchmark. Well, this is only not even a 2-year time period. The longer you run that, the bigger that divide should become over time. So there are 36 different, and I'm going to keyword this, passive indexes to pick from. There's no risk management going on like you see with our different portfolios. So you have to recognize I'm okay with taking the ride. But we also have 2 CWM diversified strategies available. We have our wealth accumulator model's aggressive growth strategy, That's 100% stocks as well, but instead of being in the exchange traded funds, we're buying it in its raw form. And the same thing with our concentrated alpha model. But again, those strategies there's not a lot of risk management that goes on there. More than just the systematic rebalancing, which I'm not going to go into because I know we're running a little late today. As a result of this, and the fact that we want to make sure we're accumulating meaningful capital losses to use against those capital gains in the future, the per account minimum in this strategy is $200,000. So to recap, because I just threw a ton at you and it was a bit of a fire hose there. The purpose or goal of this is we're trying to boost your after-tax returns through proactive tax loss harvesting. We're not investing in tax deductions. That's one of the dumbest things ever. Don't invest in tax deductions. You might as well just keep your money. As a result of this applies to non-qualified or non-retirement money only. Retirement accounts don't see any benefit from this. The number one use case we see for this is those investors like tech workers around here who have lots of unrealized capital gains in their company stock that want to start divesting away from that tax efficiently. We also see the number two use case for this, investors that just want to track the market and they're okay with more tax efficiently, but they're okay with the fact that there's going to not be as much risk management and they have to have a longer time horizon. All right. Now, I want to just throw this out. So curious how this applies to your situation. First and foremost, we are too. We are actually proactively looking through all the clients. Who is this suited for? And we're meeting with them and having that conversation. But if you feel like, hey, I haven't gotten a phone call yet, and this definitely applies to me, scan that QR code. It'll take you right out to our calendar, and you can schedule a meeting with me or Chase, maybe even Morgan. I'm not sure, to be perfectly honest, but it'll definitely be with Chase and I available on that calendar. Now, moving on to the more fun stuff, we have our upcoming events. Backed by popular demand, I think like 3 or 4 or 5 years in a row now, is our cybersecurity webinar. As you know, with AI and all of the creativity there and all the spoofing and unbelievable stuff that it's able to do now, it's more important than ever to be aware of these things. So that's going to be a webinar May 6th at 1:30. You can scan that QR code and sign up for that. I believe it will be recorded. Do you know, Morgan?
I believe it will be recorded, yes. Right.
Yeah, so if you can't make it that day, look for the recording. We'll send out that link. And for those of you who are in our Impact Club, we're going to have our summer sips. It's going to be at the Chelan Cellars Winery. That's going to be in Woodinville in the, what is it called? The Schoolhouse District. And here is where we pause for Q&A. Hopefully I didn't overwhelm everybody. Thank you guys for really attending. Any questions that people have, now is the time.
Me.
Okay.
Clients to think about what they want to ask about. I got a big one I want to ask Joyce. So, Joyce, in thinking about international markets versus U.S. markets, you and I both made the point around valuation. So, compared to the U.S., international stocks look cheap. International stocks markets versus themselves don't look necessarily as cheap. For instance, Japanese stocks are not as cheap as they used to be. Europe especially isn't. And so that's something I've been thinking about because we do have a pretty big weighting to international stocks in our active portfolios. We are currently, planning. We have a strategy in place to draw some of that down because of this phenomenon. What is your take on that, on international stocks being expensive compared to themselves?
Yes, that is something that our multi-asset team has done quite a bit of research on. And that's interesting that you said you're going to start neutralizing, because they actually sent that signal out this month as well.
Cool.
Because international has outperformed so much and caught up. And, like we talked about the S&P being expensive, high PE ratios, but the thing is that when you look at the fundamentals, like I mentioned, it's justified. So it's not to say that international's better because it's cheaper and, the US is too expensive. It's just relative. And so to your point, we also in our tactical models have been reducing the overweight to international because it has caught up so much. So it is like a relative value, but also you do have to look at valuations versus itself. And one question I get a lot is, why is the PE ratio for developed markets lower than the US? And it's because most of the PE growth has been driven by tech and the AI hyperscalers, and those companies just are not really represented in the non-US indices. So
yeah, the whole world's been chasing the same handful of stocks. I mean, it's been crazy. What about emerging markets though? Are you trimming that back?
I believe we are kind of neutral in emerging markets right now, just because emerging markets tend to be really boom or bust. They're very volatile. So they were the best performer last year, but we are a little bit cautious right now, just given the geopolitical situation and oil, right? So, higher oil prices can benefit some emerging markets that are exporters, but for the largest emerging market countries like China, they tend to be oil consumers. So higher
Mhm.
oil prices could weigh on some of those companies.
Interesting.
So you have to be a little bit cautious with oil pricing. It benefits some, but it hurts others. And with the Fed on potential pause for longer, that also would take some of the wind out of the sails of emerging markets.
Okay.
Okay,
Yep.
interesting.
Perfect.
Question came up here. I heard the dreaded stagflation as a possibility the other day. What are your thoughts?
So let's
Yeah.
first define stagflation, as I know, is a high inflation, low growth environment, and that was the big one in the 1970s. I think the environment we're looking at right now is it could be a high growth, high inflation one, but that kind of remains to be seen. Stagflation, that's a big concern. That's where your asset prices or your cost of things are getting out of control and your wages aren't keeping up, and that was the malaise of the 1970s. Joyce, you got an opinion there?
Yeah, I think stagflation, if it happens, it is a very temporary phenomenon in this time, right?
Uh-huh.
Unlike this late 70s, early 80s where it lingered, this is going to be a transition. So the way I could see that
Mm.
happening is if the Iran situation lasts longer, oil prices stay high for longer, that causes people to pull back from consumer spending. We know consumer spending is 2/3 of GDP, so that starts to slow, but inflation is high. But eventually, people stop consuming, and then inflation falls, and then you're just in a plain old recession. So,
Oh,
I,
interesting.
yeah, I
Hmm.
think stagflation it's scary, but it's usually pretty temporary because it fixes itself.
It's self-extinguishing. That's interesting.
Yeah.
Huh, I hadn't really thought about that. The only real problem would be if you have a currency crisis, right? Yeah, yeah. Let's not go there.
Yeah,
Let's not
let's
go
not
there.
even bring it
Wait,
up.
that always beckons a question about what about the U.S. dollar? The U.S. dollar is still 60% plus of global payments. It's not going anywhere anytime soon. There is slow degradation that's been happening for 100 years. So that probably continues, but it's not going to be wake up tomorrow and suddenly the dollar is worthless.
Yeah, yeah.
Right.
Okay, well, last slide here, unless you guys had more questions. Morgan?
Oh, I could go on for quite a while. I'm going to see Joyce after this, so I'm going to harass her there.
Okay, sounds good.
Yeah.
I've made this known. We've made this known when we meet with clients, but I thought it'd be good to make this known in this group setting as well, which is we have this sounding board service, and I jokingly call it my SOS. I have these cards on my desk that literally say SOS, Second Opinion Service. I hear these funny stories like, yeah, my kid, he just graduated college and he's getting his first job and he wants to know how much he should contribute to his 401k, but he won't listen to me. I've been dad zoned. Could you talk to him? Or I had one, someone was a business owner and they were contemplating, should I buy or lease the vehicle or whatever it may be. So it's been an entire array of various conversations we've had, but it really comes down to this. If you have friends, family, someone you care about, and you're a CWM client, and you're like, they won't listen to me or I don't know the answer, just, you can scan that QR code or give that to them. We're happy to have the conversation. No, we're not going to sit there and try to sell them and you're going to get this bad report like, oh my God, you sent me to some sleazy car salesman. That's not happening. Of course, we'd love the opportunity to work with them, but that's not the purpose of the call. It is purely to answer their questions. And so far, it has always reflected back very well on the person who sent them our way. So we do encourage you to take advantage of this. We also just enjoy the topic. So having those conversations is a lot of fun. And with that, that is the end of the webinar today. Thank you again so much for joining us. And Joyce, thank you again for making the flight all the way out from New York City. Hopefully the daylight savings made the time change a little easier.
Yeah. Thanks.
Thank you, everyone. Have a great day.
Thank you. Take care.